Hello everyone, and thank you for joining us for today's presentation as part of the Industry Insight webinar series. The topic this time is 7 Vital Trust Accounting Reports. Speaking today will be Erica Bursler from CosmoLex and Jerry Martin from Software Analysis Corporation. Erica Bursler is Manager of Customer Success at CosmoLex, developers of a cloud-based legal billing and trust accounting system specifically designed for solo and small law firms. Erica has a BS in Business Administration and 5 years experience in the legal software industry, catering to the specialized technology needs of small to mid-sized law firms. She has given numerous presentations on legal technologies such as law practice technology management, cloud computing, and legal billing and trust accounting compliance. Jerry Martin, a partner with Software Analysis Corporation, holds a bachelor's degree in accountancy and is a CPA. This gives Jerry the business background needed to understand the financial and management implications of implementing software and business processes. She is the past Vice President of Professional Development for the Project Management Institution Chicagoland chapter. This project management background lends itself to helping firms streamline their workflow and eliminate needless duplication of effort. The Industry Insight webinar series is hosted by the ABA Legal Technology Resource Center. To stay updated on upcoming webinars or view previous videos, visit ambar.org/industryinsight. You can also stay updated on legal technology news through our blog, www.lawtechnologytoday.org. Thank you all for joining us, and we'll now begin the webinar.
Great. Thank you so much, Chelsea. Okay, so as was mentioned, this is the 7 Vital Trust Accounting Reports, but let's first discuss all that we will be covering in today's presentation. First, we'll review what is trust accounting, also cover the 7 most vital reports and why they are so important, the best practices for record keeping, and also how can technology help. Now, this may not be what your office looks like, but I'll bet for many of you, some days this is how work life feels. Whether your office looks like this or not, you absolutely want to make sure that your trust account books look nothing like this. As we explore various items related to trust accounting, apart from my presentation slides, I'll also be using our CosmoLex software. CosmoLex is a cloud-based legal practice management system which is specifically designed for solo and small law firm needs. But ultimately, of course, it's not about a particular system. It's about learning about the issues, how they affect your business, and potential solutions. And today, we'll be focusing on the most vital trust accounting reports, as well as understanding trust accounting in general. So first, let's talk about some law firm challenges. Why do many law firms, especially solo and small firms, suffer from many efficiencies? Well, first off, law firms and law offices are different than any other service business, so they need specialized solutions, specifically designed for their needs. Other service businesses, like accountants, consultants, or doctors, their needs are very different. They don't have to worry about things such as trust accounting. So what ends up happening? Without the right technology, you waste time scrambling from one problem to the next, and with the right technology, you run your practice more efficiently and widen your profit margin. However, as we said, we can't fix what we do not know. So let's first examine some of the most pressing challenges in law firm billing and trust accounting systems. So very quickly, I want to just give a very, very top level of what law firms need. And then we're going to drill down to today's topic, which is trust accounting. So you need a law practice management system, which is your calendaring, task management, document management, legal billing system, which is your time and expense tracking, invoicing, collections. All of that is very important into running your small office. But also law firm accounting system. And this is what we're going to be getting into a little bit more detail on. Now, a law firm accounting system has 3 parts. You have your business accounting, which is your back office accounting, facility payroll, paper, computers. That's all in running the business. But you also have matter costs. This is how you bill your costs to your matters. Reimbursement through hourly, flat fee, contingency, all of that has to be accounted for. And lastly, what we're really going to be focusing on today is fee advances and retainer accounting. Also, client escrow, which, as we know, is unique to law firms, with compliance regulations in place that are not optional. So especially when it comes to trust accounting compliance and guidelines, that you need to be well aware of and make sure that you're following those to a T. So now that we understand the big picture, let's focus on what we'll be discussing today, which is trust, or also known as IOLTA accounting. So what is trust accounting? You may call it trust, escrow, IOLTA accounting. All of it is the same, just different terms throughout different industries. And state requirements and compliance are the most important when handling trust accounts, very different than just your regular business account. Also, the bookkeeping includes both how you keep your software records as well as paper trails. A lot of times when you're doing your accounting, you only need a software record. Not so with trust accounting. You have to have that paper backup as well, and we'll talk about that in a little more detail. So let's cover the different types of funds that are in trust. You may have settlement funds, which are most common in personal injury cases or real estate settlements, where you typically have one deposit, which has to be dispersed to multiple parties. Perhaps unearned income, which your state may actually allow advances or retainers to be held in operating accounts. That really varies by state. So you want to follow your local guidelines properly. And in those cases, to a large degree, it would depend on the nature of your engagement or your retainer agreement with your client. So normally, a good rule of thumb, especially when you're dealing with client funds, is if under any situation you may at some point need to return the funds back to the client, let's say you don't work for the client anymore, the case is closed, then you're better off putting the money in the trust account. You also may have advances for cost, judgment funds, maybe a personal injury case, that happens a lot with contingency, and also third-party funds. So these are the type of funds that you definitely would have through your trust account. On the flip side, what funds should not be in trust? Personal funds. Really, anything not client-related does not belong in trust. Now, in some cases, a very small amount of personal funds are allowed in the trust account to cover for service or bank charges. But ultimately, if you have a proper trust bank set up, those bank or service charges shouldn't come out of the trust account to begin with. Earned income, which is to be withdrawn and deposited into your business account, that of course is not, once it's earned, it needs to be taken out of trust and put into your business account. Payroll, which of course is a business expense, so that does not belong in trust. And any situation where you're not the fiduciary trustee, you should not be managing those funds in a trust account. Now, the reason why we're talking about the types of funds, the types of tools, which is here as well, is because all of this eventually filters down to your reports. You need to have your data and your bookkeeping handled properly first to give you a sound foundation for your reports to come out properly. So in terms of the tools for trust accounting, manual, which includes written ledgers or spreadsheets. You may be using a generic accounting software such as QuickBooks or something similar, and that's very typical among many small businesses. Or a legal specialized accounting software, which caters to the unique needs of attorneys. Now let's outline what makes trust easy to manage. First, there's no profit and loss to calculate. You just have money in and money out. There's also no depreciation or amortization. There's no interest accumulation. Even in an IOLTA account, any interest that's deposited must be withdrawn almost instantly, so there's no tracking on that standpoint. There's no tax accounting. There's no income involved, so you don't have to worry about that. And there's no account management for fees or bank fees, as those amounts should always be deducted from your business account, which is something I mentioned earlier.
So Eric, sorry. I was just going to comment on the trust accounting. When we talked about no profit and loss, the amount of your balance needs to be zero when that matter is closed. You need to refund the money. It should always end up being zero. Accumulation of interest, if you set up an actual trust account, so you need the proper banking institution. You can't just use a checking account that you just set up as a regular checking account and just put the name on your check that says trust. That doesn't make it a true trust account. In a true trust account, there is any accumulation of interest that happens is awarded and then going to your state bar association. So there's no interest that should be maintained in there, regardless of the balance. And also, no bank fees should be coming out of that. So if your bank doesn't know how to do those things, then you really need to find another banking institution for your trust accounting. Thanks.
Great, thank you, Jerry. So let's talk about what makes trust accounting hard. Now you have a whole list of items that make it easy to handle. So you might be thinking, what's so complicated? However, these next 3 items are essential and very unique to trust accounting. First is you must track funds for each matter. The bank knows your total account balance, but only you are responsible for knowing at all times what portion is for which matter. You also must reconcile your books monthly. There's a lot of flexibility when it comes to a business account, since that's your own money. However, when managing client funds, monthly reconciliation is not only essential, it is an absolute requirement. You also must maintain an audit trail, and this is for the same reason. When dealing with your client's money, you must account for every action taken on that account and have a good record for it. All right, so what tends to go wrong at law firms? Now, here we're not talking about knowing misappropriations, which is theft, personal use, anything that you're purposely taking money out of a trust account for your benefit. We're not talking about that. A vast majority of disciplinary cases, about 95%, are related to poor record keeping and compliance practices and not deliberate misappropriations. These are known as negligent misappropriations. And believe it or not, even though it's just based off of negligence and it's not something you did on purpose, in most cases those also have severe consequences as well. So as you see here, the list is pretty long, and today, of course, we're going to be focusing more so on the reporting aspect.
One of the things that you want to take care of when you're looking at some of these is that you make sure that you're only using this money for your clients' costs or to reimburse yourself for earned income. And remember that your income's not earned until you bill it. I see very often where clients, they're going to do the billing at the end of the month, but they take the money today because they've done the work today. That's not appropriate. Until there is an invoice generated, you have not earned the money. So you need to worry about your timing, and those are some of the safeguards that you have to keep in place so that you're sure to take the money at the right time. Also, another thing that happens frequently is people grab the wrong check. They grab an operating check and they cut the money out of the trust fund and they print it on an operating check, or vice versa, where I've taken a trust check and put it to pay an operating check. So I would advise you to use different color checks for your trust fund and your operating account, and even better, use a different form. Use a form for your operating, let's say, is going to be just 3 checks on a page, but your trust fund might be check stub or something, so that if you accidentally pulled the wrong one, it would be very clear that you've pulled the wrong check. Thanks, Erica.
No problem. Thank you, Jerry. All right, so now that we understand really how trust accounting should be handled, some of the things that might go wrong, and how you can prevent those issues, the main topic of today, of course, is those most vital trust account records. Here we have and we'll talk about each of these in detail, your bank ledger, receipts journal, disbursements journal, client ledger balances, individual client trust ledger, and for reconciliation, your bank reconciliation and that 3-way reconciliation report. This is what we consider to be the 7 most vital trust accounting reports. And especially with trust accounting, proper reporting and recording is an absolute necessity. Now, before we get into too much detail on the reports, I do want to bring up best practices. And this is just a rule of thumb, what you should go by, especially you're really preparing for an audit, essentially. If somebody were to look into your books, you want to make sure that you have all the proper reporting there. So first is to have records up to 7 years. That may be required if you have an audit. Every state's different as to the audit practice. Here in New Jersey, we have a random audit, so it goes based off a phone number. They just randomly, give you a phone call and say we're going to come to you in a couple weeks. Some states, you only get audited if you've actually overdrawn your bank account. It depends, but when that time comes, and depending on the issue that arose the audit, you may be asked for up to 7 years of records, so you want to keep that in mind. Also, apart from these reports, physical copy of the actual instruments, which is deposit slips, canceled checks, paper statements, that too is required. So you want to make sure to keep all of your proof available in case you ever were to get audited, because at the end of the day, a report is only as good as what's on paper. You need to have the actual items to back that up as well. So I've actually generated a copy of each of these reports from the CosmoLex software, so let's quickly go through each of these records and explain their importance. First is your bank ledger. Now this is pretty much your bank activity report. Everything, money in, money out of that particular trust account. It's a combination of your receipts and your disbursements, so your checks and your deposits. You also have all the entries listed, including voids. You have the date, payee, payor, amounts, purpose, client. All of that important information needs to be on the report, along with the running balance. The key for the running balance is whoever's looking at the report needs to be able to tell very quickly if there was an overdraft in this account. And that's what the running balance will help them to find out. Now, of course, in addition to this, you're going to need a separate receipt and disbursement ledger. So this is the combination. This has your checks and deposits, but you're going to have reports of those separate items as well. So the cash receipts journal is only your deposits. So this is a listing of all your deposits, and again, this should match up with your bank activity report. We have your disbursement journal. This is all of your checks cut out of the account. I feel like this one even more so where the money ends up, especially if it's not just you, if you're dispersing it to other parties. It's important to track the disbursements very closely. Client funds, okay, this is the ledger card balance report. This is very critical. This report actually provides balance for each of the clients in your books. However, you need to remember that some checks may be in transit and have not hit the bank yet. So until those funds are cleared from the bank, you're still in possession and responsible. So you have to have some sort of record of not just what you have in your books, meaning what I have marked as entered. You need to know what has been cleared of that and uncleared so that you have a good idea as to this case is not yet closed until this check is cleared. Now, an example of this is if you wrote a check, let's say for $100 a year ago, and perhaps the check was lost in the mail, your books will show the client balance to be zero as you close that file, and you may be thinking, everything's fine, funds are cleared out, I'm good to go, but those funds never cleared the bank, so you still need to follow up with that, and you're ultimately responsible.
Erica, I wanted to add something to this about this report, is that we often have timing issues with trust accounts where money is deposited, let's say the last day of the month, and so I go to the bank, I deposit the check from my client, and that check is going to show, that deposit's going to show as uncleared, but then I start spending money. And so we have this overlap, or sometimes the check never actually got deposited. You just recorded it. There's all kinds of things that happen in these trust accounts that's very important, and this is a great report because it's right in your face that there is an issue, and it tells you exactly that you have an issue and that these are things that you ought to be looking into. You can't keep dismissing a deposit that's uncleared for a month. There's clearly something wrong. Same thing with checks. After 60 days, if a check hasn't cleared, then it's likely that the client hasn't received it, or whoever you're paying it to hasn't received it. So this is a great report to look at.
Great, thank you, Jerry. Yeah, and there's a few reports that will bring up this uncleared topic. It's so important because if a lot of people think, and especially with your own business account or your personal account, you cut a check, the check gets lost or whatever, you're not too concerned about it, it eventually will come up, you'll figure it out. Trust accounting is very different. That is not your money, it's your client's money, and you need to make sure it's handled properly. You are ultimately responsible. You can't blame the bank, you can't blame the client for giving a wrong address. You are responsible for those funds and making sure they get to the right person. All right, individual client ledger cards. Okay, so ledgers are something really unique to trust accounting. You need to, at any point in time, be able to identify how much money and what activity has occurred on a particular matter. So this is like a mini bank statement for a ledger, which is your individual matter. And it also must have a running balance. And this is for the same reason as I mentioned on the bank activity report. You need to prove that there is no negative balance, even on the individual ledger. So that's what that running balance is there for. And that brings us into reconciliation. Now, monthly reconciliation is an essential piece to proper trust accounting. And this, of course, along with the associated reports, which we're going to be talking about in a little bit. It's something you need to handle each and every month. Now, we cannot stress enough how important this process is, as mistakes made a while back are even harder to fix. I have many customers that are reconciling 2, 3, I think I had somebody over 5, 6 years ago. They find mistakes, they really don't know what happened in real life or how to fix it. They end up, trying to make up for it in adjustments or something like that. If they get audited, they're going to have to explain that. So the quicker you find these mistakes, the quicker you can fix them. It will avoid headaches and also make everything squeaky clean and very clear for an auditor if they were to look at your books. Now, 2 reports come with reconciliation that are very important. The first one is the reconciliation report. This is just a summary of your reconciliation, and again, reconciling is just comparing your records with your bank statement and making sure everything is good to go. But of course, even after you reconcile, you're going to have some items that are uncleared, and this brings up what we just talked about a couple slides ago. That is the most important thing on this report. Not only does it summarize your reconciliation, what's cleared and uncleared, those uncleared items, if you print this report out every month and month to month to month, you're seeing the same item linger there, that's a red flag to you, and you're able to address that much quicker than if you were not generating this types of reports. You also have your 3-way reconciliation. Now this is very unique and specific to trust accounting. Why? Well, because you wouldn't do this with your business account, because with a business account you don't have individual matter balances. Only with your trust account are you responsible to know those individual ledger card balances. So here, the 3-way check is the book balance total, the bank balance total, and the individual client ledgers. If you have 200 open matters, all of the totals of the balances for each one of those matters needs to add up to the same number. If you're keeping manual records, that would be very hard to put together. Also, if you're using some sort of general accounting software, it's not built to do trust accounting or this type of activity. So you'd have to highly customize those reports, but you need to make sure that this 3-way check is in place in order to have what auditors tend to look for when they're addressing your trust account. Legal specific softwares are where this comes into play because, of course, trust accounting is specific to law firms.
Erica, this is the one report. Every accounting package has a bank, and I shouldn't say every. Let me take that back. Most have a bank reconciliation report. This is the one report that takes it to the next level because we do need that 3-way reconciliation. Just because your bank balance matches your book balance, that's not enough. We need to make sure that our liability for each of our client ledgers, or in total, match what we say is our book and our bank balance. And the only way that that can be done is by a lot of extra steps if you have a non-legal type of software package. So this is one of the things that distinguishes us from the QuickBooks or the Xeros or the Sage 50s of the world, is that this particular reconciliation is very important, and it can get easily out of balance by accountants who do not understand how trust accounting works. And the accountant will see that there's a difference between the book balance and the bank balance and create a journal entry to get the two of them in compliance with each other. The problem with that is that we've not hit the client ledger, the matter ledger, that makes that effect go all the way through. And that's how we get ourselves into trouble, where those balances no longer reconcile.
Yeah, Jerry, you brought up a good point with accountants. We would all love to say, oh, my accountant knows everything about accounting. They'll handle it and they'll know what to do. Just like we said, your banks, you need to make sure that they understand trust accounting and legal specific guidelines. Same goes for your accountant. If you're working with an accountant, you need to make sure that they understand the specific needs of a law firm, the requirements, and what is necessary for compliance. Last thing you want is your accountant to take shortcuts, saying, oh, well, I just need these numbers to match, and do a little, fudging like Jerry mentioned, throw in a journal entry or an adjustment to make everything look okay, because they're not aware of the big picture for a law firm. So make sure also when using an accountant that they're aware of those guidelines. Okay, so once you have some sort of system in place, these are good guidelines to follow. Again, this is like a trust accounting workflow. This is what's most important. Keep those client funds separate. You need to be able to easily identify what the balances are for each and every matter. Print your checks and deposit slips. Jerry brought up a great point. I mean, you can manually do checks. That's fine too. But if you have it set up to print in bulk, you're less likely to make mistakes. It's also neater and won't be misread, I guess you could say, and you won't be putting the wrong amounts in there, and less likely to choose the wrong bank, especially if you're doing it all in a batch from a software. Your monthly bank reconciliation, that is not a suggestion, it's a requirement. You have to reconcile each and every month. Some attorneys even, check it every day. And that's up to you, but at least monthly is required to make sure you catch any of those mistakes and fix them as soon as possible. The three-way reconciliation. Now, once you reconcile your account, you can generate those two reports that we mentioned, the reconciliation and that three-way reconciliation report, but you want to get that every month to make sure everything's okay. Print the other required reports. Like we said, there's 5 or 6 other reports in terms of your bank activity, your client ledger balances, your transaction reports. All of those need to be easily accessible for you. And keep proper records of instruments, deposit slips, canceled checks. All of that you need to have the physical copies of in case somebody were to question a particular transaction. So with that, I wanted to give you a little bit of a visual to go with what we're talking about for trust accounting. And like I said, the reports are the end result of doing proper trust accounting. If you're doing incorrect trust accounting or you're not following your client balances, your reports are going to show that, and they're going to be completely inaccurate. And you need to make sure that everything is compliant, which is the first part, and accurate. So let me just switch to the CosmoLex program. And there's just a couple things I want to pull from that workflow I was talking about, like what's most essential for trust accounting, and understanding how you can simplify it and how you can make sure that you're following those guidelines. So first of all is my matter list here. Right now I just have all the matters in front of me. Again, I'm in the CosmoLex software. And because this is legal specific, right away I have everything set up where I have my client and matter, and all the way to the right I can see that trust balance. If I were to do any activities, whether it's receive a retainer, cut a check, it's going to affect specifically that matter. and of course your overall bank balance, but none of the other matters. So that avoids any sort of commingling. If I wanted to cut a check, let's say for this particular matter, I only have about $2,600 in trust for this matter, but I have, let's say for sake of example, $500,000 in trust amongst all of my matters. If I wanted to cut a check for, say, $3,000 for this matter, any other software, let's say it was a general accounting software, even of course manually, you'll be able to do so because there is a balance in the bank. You have about $500,000, so of course you can cut this check. But according to trust accounting guidelines, you should not overdraft on a ledger. If you were to be able to cut that $3,000 check, you're technically taking about $400 from another client, and that is going to show up on your client ledger activity report. It's going to show a negative balance there, and it's going to be questioned. So to have a tool that will actually stop you from doing this action is very important. Also, having a system that's all-in-one, for instance, CosmoLex, you could do your trust accounting, your billing, all of that together. That is very beneficial, especially if you're doing your invoicing, whether it's fixed fee, hourly, whatever the case may be, because you need to debit trust but pay your invoice at the same time. So if you have two separate softwares, you need to make sure to keep track of the retainer balance from a billing standpoint and your invoice balance, but also the total client funds from an accounting standpoint. Having all of this in one application would make everything much, much simpler for you. So if I were to select a particular matter, go within there, you'll see right away I have a very clear idea as to what my unpaid balance is and what my retainer is. I don't have to reference two different softwares, two different lines, possibly looking at the wrong matter. Everything's here for this particular matter. And very easily, because it's an integrated system, I can pay this invoice using trust. I can debit the trust either as a check or a wire. And in one step, something that would normally take 5 steps, I'm able to reduce the trust retainer and my unpaid amount will go to 0. And that's how having your billing and trust together is very beneficial. Go ahead, Jerry.
It also, behind the scenes, it's making all those journal entries to relieve the liability account and to increase the operating account and decrease the funds account, all of things that you as attorneys don't really care about. But all of those things happen automatically for you so that you don't have to worry about what's a debit, what's a credit, should I use this, should I use that. It's all taken care of right away.
Yeah, and that's an important part, and I won't go into too much detail because I know we're not covering business accounting today, but as a small business, you're responsible for recording these activities from an accounting standpoint. So like Jerry said, when you add a retainer, that's a liability, it's not income. It becomes income when you pay an invoice and you earn it. Here in the system, since it's all integrated, your billing, your trust, it knows, the system already knows when that trust is applied to the invoice, it will then switch from a liability to income. So that's a little bit advanced past today's webinar, but it's a very important part to bring up, that having everything together, even though it's your client funds, you still have to account for it from an accounting standpoint. All right, so next is reconciliation. Like I said, your full workflow, and CosmoLex has trust accounting from start to finish, so you could manage your retainers, cut your checks. You can also pay your invoices, but what really rounds that out and what a lot of programs are lacking is the ability to do full reconciliation and print those necessary reports that we've talked about. So for instance, if I were to select my particular bank, go to reconciliation, I can look at one of my statements here, and you will see all the deposits, all of the payments, and you just need to check off the items that have cleared. Of course, you're comparing with your bank statement. And on the right, you have your nice little summary of cleared and uncleared transactions. And at the bottom, your difference must be 0 in order to reconcile. At that point, you can go ahead and close your books. If it's not 0, that's when you have a mistake somewhere, either in your records or the bank records, and it needs to be addressed. Now the reports. Reconciliation is the first step, and then you need those reports that we talked about to really back that up. So if I go to the reporting section, you need to be able to generate these quickly, easily, because if it's hard or cumbersome for you to do, you're just not going to do it. You don't want to, take way too much time out of your day that could be spent working with your clients worrying about all this reporting, and we understand that. So for that reason, you need to be able to access, like we have here, your reconciliation report and your three-way reconciliation report simply. So if I select a bank, my particular month, and just generate, that's all I need to do. All the data is already in the system, and this goes for all the reports that we talked about today. In one click, you're able to generate that report, pull it up really quickly, and you'll see here I not only have the summary of my bank and book balance, but also all of those individual client ledgers. They're all added up for you, and you can see that that number 2 matches. Okay, so you want to make sure that whatever solution you choose will help you to get this the most painless way possible so that you keep to it and you make sure that you do it every month. All right, so with that, let me just wrap up today's presentation, first covering what we've learned. We now understand trust accounting, the basics, also the proper trust account records, record-keeping guidelines, and how technology can help you remain compliant with all of this. Your next steps. First, identify any record-keeping issues in your practice. You may have noticed there's a bunch of reports you never heard of, you never knew they existed, or I'm taking hours to make this report, this only took a few seconds. Anything that you think can be improved, identify that and first figure out what those issues are, and then ensure proper reports are being filed and maintained. So now that you know what is essential, make sure you have a way to generate those and file them and maintain them on a monthly basis. And lastly, research and implement a tool to ensure proper compliance going forward. If you see any shortcomings in your process, anything that you think can be improved, look for a tool, look for something that can help you to remain compliant and make your job a little bit more simple. So go ahead, Jerry, do you want to add something?
Yeah, I was just going to say we had talked a little bit about choosing the proper bank that actually has true trust accounts. You want to also be aware that when you are using a credit card merchant and you are accepting retainer money or escrow money from your client, that through a charge card, that your credit card company does not put the fees against the payment. So if my client is giving me a retainer of $1,000, the full $1,000 must go into my trust account. The fees for that $1,000 processing need to come out of my operating account. You cannot allow the credit card company to put, let's say, $950 in, and then you write a check to the trust for the other $50. That is frowned on. The entire amount needs to be credited, and you can look at credit card companies like LawPay. I know works with CosmoLex and a lot of other packages. They do a really good job of keeping those things separate. So it's important that the client gets credit for all the money that they've given you.
Yeah, that's a very good point. A few times throughout this presentation, we've talked about things that you may think are out of your control that are not, like choosing banks that handle trust accounts properly, choosing accountants that understand the guidelines of trust accounting and legal specific rules, and merchant accounts for credit card processing is just as important. It is your responsibility, not the credit card processing company, to make sure that those guidelines are being followed. If you're currently using a merchant or a bank or an accountant who doesn't want to follow those guidelines or doesn't understand it, that's your responsibility, and you want to make sure that you're using the proper tools and services that will help you to remain compliant, because at the end of the day, it is your business, it is your firm that's on the line if something were to happen that's not compliant. Okay, great. So I just wanted to give a little bit of summary of what CosmoLex has to offer. I mean, A full practice management solution is much more than just trust accounting. You need your time and billing, you need your business accounting, calendar, task, document management. Of course, we're not focusing on that today, but we want to make sure when you're finding a proper trust accounting solution, you take the rest of this into consideration, because an all-in-one tool, especially if you're a solo or small law firm, can definitely be beneficial for you.